All right, I think everyone is in here at the moment. Um, Hope everyone can hear me well. I'd like to say hello to everybody. My name is Jason Drummy. I'm an investment assistant at Aquest Wealth Strategies, and thank you all for coming today. We really appreciate that you can take the time out of your day. So today our speaker is Mark Peterson. He is the director of the Market and Portfolio Insights team at BlackRock. He's got over 25 years of experience in the industry and focuses on investment strategy and education. So today, Mark will be sharing some insights on the current market environment and how investors can think strategically about portfolios moving forward. So with that, I'll turn it over to Mark. And again, thanks everyone for showing up tonight.
Great. Thanks, Jason. Evening, everybody. Thanks for having me on your call today. Talk a little bit about the markets, where we're at here at the end of 2025, heading into 2026. Certainly no shortage of content, right? Ton of things going on, government shutdown, certainly a lot of geopolitical things. No dull moments here, but we'll try to hit where we think things are headed. Generally, pretty good place here. We've got an economy that's avoiding recession, and the Federal Reserve is lowering short-term interest rates, so that should be a good backdrop, and we'll see that throughout the slides. Also, certainly, inflation's a big story. We'll touch on that a little bit. That'll be a key for 2026 is keeping that inflation number in check. So we're going to do it as we always do through our what we call our student of the market piece. This is something we normally send out to advisors only. But Jason and the folks at Aquest have made it available to you all tonight, which is a good thing. But you can find that if you just Google BlackRock Student of the Market, our page will pop up there, and you can find some other information out there if you want more. And you'll notice right away, and I think Jason knows I'm a chart and graph person, so didn't leave many on the floor today. So bear with me as we bring these to life. So let's jump right in and just talk about where we're at with returns so far this year. Pretty good story. International stocks actually leading the way, up 25%. U.S. stocks up about 14.8, and U.S. bonds up 6.1. Cash up a little bit less than 3. So pretty darn good across the board. Of course, international stocks leading is a little bit different than we've seen the last handful of years. I think 12 of the last 15 years, U.S. stocks have beaten international stocks. So this is a little bit different environment. The main reason for that is a weaker U.S. dollar. So when you get a weaker U.S. dollar, you're translating those international stock prices back into more U.S. dollars. So that helps performance. It's been about a 10% bump in performance from the weak dollar this year. So certainly a nice little diversification benefit. Seeing that portion of the portfolio that really hasn't pulled its weight here over the last bunch of years really add to the mix this year is a nice tweak. U.S. stocks actually had their second best summer since 1950. And you see the numbers in the gray box, up 20.8% in the months from May to September. I'm in Chicago here, so May to September is a little bit generous, calling those summer months. But you get the idea. It was a great rebound. And of course, if we're only up 14%, that means we were negative through April for U.S. stocks. So very different ball game this back half of the year, second best summer in history. You can see on the right side, we pulled in all the best summers going back to 1950. And you can see, I think the thing that jumps off the page for me, look at the far right-hand column there. Whenever you had a really good summer and you built up momentum, it carried through to the fourth quarter, and you were positive in each of these top 10 best summers since 1950. So history doesn't repeat, but it often rhymes, right? We see that with markets and economies. Look at some of these summer months. 2024 last year was good, 15%. We added another 2.4% in the fourth quarter. But you have some other periods where returns were actually pretty darn good. Look at 2020. Looks pretty similar to this year, up 16.4%. You were down a little bit early on given the pandemic, but you had a nice rebound in the fourth quarter, up 12%. So hopefully this summer momentum will carry through for the rest of the year. Certainly history tells us that's been the case. Government shutdown, we're what, on day 15 or 16? I'm losing track of my government shutdown day clock here. Hard to tell exactly when it'll end, but generally the market shrugged it off. We've seen the market's been up since the shutdown, and that's been the case historically with these shutdowns. Normally they don't last this long. Normally they last only about 4 days, but we've had some that have lasted longer. But look at stock market performance during the shutdowns. Really doesn't hasn't blinked an eye much historically. 1 year after a shutdown, up 12%. And you can see on the right side, here's a list of all the shutdowns. I think it's a little bit more common than folks realize. Normally, again, they're a day or two, especially in the 80s and 90s. Of course, the last one was one of the longer ones in history at 34 days. But you can see even 95, 2013, you had double-digit days here. But again, you can see the right side. The market really shrugged it off from a performance standpoint. I think one of the challenging things the market's going to have to deal with if we stay shut longer is just the fact that you're not getting a lot of government statistics and numbers coming out of the government that you normally rely on to get a good feel for where the economy's at, whether that's the job market number or inflation, whatever it is. We are going to get inflation next week, but the jobs number is missing. So that certainly creates a little bit more uncertainty, or at least clouds the market's view a little bit. But again, markets generally shrug off these government shutdowns. Here's the economy story, not too different than what we've touched on in the past. An economy that's avoiding recession. It's not perfect. I think we all know that. It's slowed a bit, going into really, from the middle of last year, but rebounded nicely in the second quarter of this year. Some of that is just the tariff adjustments. You had a little bit of a tariff front running in the first quarter that hurt the economic growth numbers, but you saw some of that bounce back in the second quarter. And the rest of 2025 looks good. Again, not perfect, but well away from recessionary levels. The job market on the right side, always a big story, or kind of the heartbeat of the economy, is definitely softening and really normalizing, I think, is the way most folks would say it. Post restart from the pandemic, changes certainly to immigration and some government job policies, certainly a little bit more of a headwind than they've been in the past. But still, we think even with a softer job picture, we still think it stays away from that recessionary level. You'd have to have a lot of negative months where you're taking away from jobs in the economy, and you can see there's only one negative over this period of time. The rest, right? If you can average right around that 100,000, that's reasonable shape. Certainly not perfect, but reasonable shape. I mentioned inflation earlier. I think this is the big story for 2026. Is what happens with inflation. There's still a lot of money sloshing around out there. Think about stock market hitting record high, Bitcoin hitting record highs, housing market near record highs, record amount of money dollars on the sidelines in money market accounts or cash. That still feels a little bit inflationary, like there's a lot of dollars out there. Inflation is down to 2.9%, so not bad, but it has trended up slightly here over the last handful of months. We are going to roll off some bad numbers from the beginning of this year, late last year. So hopefully that absorbs some of the other, if we do see some pressure from tariffs. I think this number will stay in reasonable shape, though, in 2026. We are moving into a better place. Some of the housing costs that have been a big part of the inflation have really started to come down. And again, that could be a little bit of a buffer for some higher tariff-related price pressures that we get coming through. So it'd be interesting to see, though, because this allows the Federal Reserve to lower short-term interest rates. So if we keep inflation in check, that'll be good news for more Federal Reserve rate cuts in 2026. And this chart did a little Hollywood Squares for those who remember Hollywood Squares, but just looking at different scenarios on what's going on in the economy and the markets, really focusing on two different dynamics. One is recession, no recession. So you can see recession is on the bottom, and you can see what that does to the red bar across the bottom of the slide. Look at stock returns whenever you have a recession. And then across the horizontal, we looked at whether the Federal Reserve is lowering interest rates or cutting rates, whether they're on pause, which is normally the case, or whether they're raising rates. And you can see that the environment that we're in right now, and I mentioned it, certainly beating it like a drum, is that we have the Federal Reserve lowering short-term interest rates, but we don't expect a recession within the next 12 months. That is the best environment historically for both stocks and bonds. Here's the average return whenever you've been in an environment when no recession within the next 12 months and the Federal Reserve is lowering interest rates. You average 17% for stocks, 7 on bonds since 1990. That's as good as it gets for overall portfolios. Not the best environment for bonds. You can see bonds actually do well when stocks don't do so well in a recessionary environment along the bottom. But you can see when you don't get a recession, you see how well stocks do. But bonds do their best when the Federal Reserve is lowering rates in that environment. So really a sweet spot for us from an overall market backdrop, right? Keep focused on that. No recession, Fed lowering interest rates. That's a good backdrop for portfolios. And that's what really broke in the first half of the year. If you think about when we were concerned about tariffs and all that uncertainty, was that going to cause a recession? That was why stocks were down through the end of April. Once we got back on track and we could see, you could see the tariffs might not have the immediate impact that people were concerned about, that it might drag out a little bit longer and take longer to really get felt throughout the economy. Then the stocks got right back on track on this story where, again, no recession, Federal Reserve lowering interest rates. That's a real nice formula for us historically. Big question we get right now is with the market doing as well as it has, a lot of that has to do with the excitement around artificial intelligence. And I think for a lot of folks brings back memories of the dot-com technology bubble of the late 90s, early 2000s. But it's very different this time around. And we just pulled in earnings growth during the technology bubble and stock performance. So what the stock market return? And this is just for technology stocks, by the way. Look at the story today. Very similar from a earnings growth standpoint to the technology bubble. But look at stock returns. It's not even 1/4 of the returns of what the technology bubble did from mid 1996 to the top of the bubble in March of 2000. Really different ball game today. As good as returns have been, it's nowhere close to what we saw in the technology bubble. And it's not just that period. You can pull the last 1 year, 3 year, 4 year, very similar story where you're just getting a similar amount of earnings growth. And even 1 year, right? It's even better if you look at the bottom right hand corner, where you're getting twice the amount of earnings growth that you saw during the technology bubble, but much lower returns for overall U.S. technology stocks. So very different ball game, we think. Certainly, you're seeing bigger companies, not as many of those fly-by-night.coms that didn't last. These are some big established companies with big earnings that are investing heavy dollars in artificial intelligence. So we think there's a lot more room to run here. Lots of excitement. There's going to be different winners and losers. Maybe some of the easy money has been already made here. We're already seeing that this year a little bit, where some of these artificial intelligence companies, some have continued to do well, others struggled. I think that's something that's going to continue going forward, where maybe it's a little bit more of a divergence, not just anybody with AI in their business model does well. This will be much more of a winners and losers story. And we certainly saw that in the tech bubble. But I think this helps tell the story. Really, the chart on the left, especially, I think jumps off the page at you. I think we all forget how much stock prices went up during that dot-com bubble. Different ball game than what we've seen the last handful of years. Switching gears a little bit to the stock market by presidency. This is one of my favorite charts that we did a lot last year. I think we did it for everybody, at least did a handful of the slides on the election. We had an election special that I did more times than I'd like to admit. Pretty obnoxious at the end. But I think this is my favorite by far. It looks at different parts of the stock market. So just different sectors like energy, healthcare, technology, and looks at the various presidencies, the last 5 administrations. And you can see what was the best and worst performing parts of the stock market. And I always focus, look at Obama and Trump 1, right in the middle, kind of the middle left-hand side of the slide. Look at the best performing sectors under Obama and Trump. almost identical. Technology, consumer discretionary, healthcare, right? Slightly different order at the top, but the numbers amazingly the same or similar. And then look at the very bottom under Obama and Trump. Energy, the worst performer. So even though these administrations couldn't be more different, right? Both policy and stylistically, the performance of the stock market over this really 12-year stretch was remarkably similar. And this is what we say in the top left-hand corner. You can see, and you probably remember this from last year, keep politics out of your portfolio. Even though these administrations were dynamically different, how the market performed was amazingly similar because the market was more responding to the fact that the long-term cycle where we were at and what was happening at this point was we were recovering from the global financial crisis. The economy was healing, really getting better. And on the other side of that, it was the longest U.S. economic expansion in history. So it wasn't the best economic growth ever, but it was actually the longest time periods between recessions. And if it wasn't for COVID, we probably would have kept on trucking along to even a longer gap between recessions. So that was the story that drove the market. You can see the sector performance very similar, even though the politics were completely different. I think really speaks to why we want to keep politics out of our portfolio. The market has its own momentum, its own story, its own narrative to it. Energy being the worst performer, right? That's just nothing anybody would have predicted based on the difference in policy. And you can stare at this chart, and I apologize. I couldn't jam more colors into this one. But look at energy under Biden and Bush, right? Different parties, but energy was the best performer. And probably the Trump administration has been around long enough to tell. And look at technology, the last four administrations, right? Been a dominant story regardless of who's been in the White House. So thought this was a good reminder for all of us to maybe be a little bit humble about our politics, maybe check them at the door a little bit, especially when it comes to your portfolio. Keep your politics out of your portfolio. The market has a greater momentum and story to it, and we've really got to follow that and think about what we've been touching on throughout this presentation. Our story in the market's good. We've got an economy avoiding recession, and we have the Federal Reserve lowering short-term interest rates. That's a sweet spot for portfolios. Don't let your politics get in the way of that. We mentioned the Federal Reserve lowering short-term interest rates. Here's actually the level of rates. So you can see they lowered rates a couple times last year. They lowered them in September. We think they go a couple more times this year. So maybe 0.5% this year, maybe a couple times next year, really depend on that inflation story, but get down to a lower level, maybe below 4, closer to 3%. And the good news on the bond side of things is bonds generally do well when the Federal Reserve is lowering short-term interest rates. This is just a simple look at all the various bond categories and how they've done 1 year after the Federal Reserve begins to lower interest rates. And you can see it's good across the board. Various bond categories all look good and certainly a lot better than cash. Even shorter term bonds do better, much better than cash when the Federal Reserve is lowering those short-term interest rates, because generally when the Federal Reserve lowers short-term interest rates, it affects those cash-related accounts first. So you'll see that money market accounts, some of those CD rates at banks will start to come down as the Fed continues to lower short-term interest rates. History says you're much better investing those dollars in bonds as interest rates and income comes down. And here's the longer-term story for bonds here. And these are longer-term interest rates, so less affected by the Federal Reserve, but still part of the story. You can see we're right about where we were back in October of 2022, right around 4.2% on the 10-year Treasury bond. We actually hit a little bit below 4 today, but we've really kind of bounced around in a range here the last handful of years. And, we think this really continues because it's a bit of a tug of war between the fact that the economy is cooling. We're seeing softness in the labor market, which will help interest rates go lower, right, if the economy is not growing at too hot of a pace. But we also have a ton of debt and deficit challenge out there that's an overhang. So it's really a tug of war between those two, because more debt means higher interest rates potentially here in the U.S. That's been the tug of war. But again, if you look at things outside of cash, what's delivered since October 2022, is really some of these bond strategies beyond cash, beyond core bonds. Non-traditional active bond funds have delivered a lot of performance. We think that'll continue on into 2026. We think we'll very much stay in this range bound environment where we kind of bounce between 3.5%, 4.5%. We think that's just the new world for interest rates and bonds going forward. And honestly, it's a much more normalized environment than we were during the pandemic, when long-term interest rates were below 1% on the 10-year Treasury bond. That just wasn't a healthy environment for bond investors. We're in a much better place today, and I think you're seeing that in returns. Last chart here for you is on diversification. We've probably hit this one in the past, but I think it's important. And similar to some of the charts we looked at earlier, look at what happens if you invested $100,000 at one of the worst times in history, right before the global financial crisis in October of 2007. You were down 55% over the next year and a half, roughly. That never feels good, right? To lose more than half of your dollars. But then look what happened the rest of the way. You had a big rebound, then you had COVID pullback. You lost about a third, and then 2022, when we had the inflation and higher interest rate shock, you lost about a quarter. But you can see even today, you're up over 624,000 on $100,000 initially invested. Not too shabby in U.S. stocks, considering you had 3 bear markets and some of them historic, right, in the mix there. Just shows you the resiliency of U.S. stocks, right? Pretty amazing when you think about it. All the drama that we've had over this stretch, and U.S. stocks and the U.S. economy has been amazingly resilient. It's been a terrible bet to bet against U.S. stocks and the U.S. economy, not just over the last, 17 plus years, 18 years, but over the last 60 or 80 years as well. But if we look at a diversified portfolio, in this case, we're just looking at capturing 90% of all the bull markets and 90% of the bears. Look at what happens to our overall outcome. This is really the story of why we diversify portfolios, is you don't need all the upside of what the good markets bring. Just get a chunk of it. In this case, 90% is the number that works, but it still looks good lower as well. So instead of being down 55, you were down 50. And the same thing on the way up. Instead of being up 529, you're up 476. Look what happens at the end of this period, though. You actually outperform, where you end up in a better place, even though you weren't capturing all the upside of what the good bull market brought, because you found that sweet spot in the math where you're getting 90% of the upside, limiting losses to 90% of the bear market. You actually ended up in a better place. And you did so with less risk, less drawdown, less volatility as well. Look at some of the drawdown periods during the bear markets. You're much better on the right side of the slide than you are on the left. This is what we call BlackRock winning more by losing less. Sounds a bit like a riddle, but winning more by losing less. Capture a chunk of the upside of what the bull market brings, limit losses in the downturn. That's how you build wealth over time. It's just tough emotionally as you go through these periods, because it never feels good to lose money, especially some of these numbers on this slide. And it doesn't feel great to trail the U.S. stock market in periods like this we're in right now today, when the market's up and having a nice run. So I think it's good just to remind ourselves why we build portfolios the way we do, why we asset allocate, diversify, and spread your investment eggs across a variety of investment baskets. It's all to get to this winning more by losing less story. It's just emotionally challenging, as you probably all have experienced at some point of this cycle. So good place to land. Even some of the best investors we work with need this reminder from time to time. So I think it's always a good way to wrap up the story. But hopefully that was helpful. Think about where we started. It's been a great summer. Generally, that's historically, that's good for the fourth quarter. That momentum carries through. Of course, the AI excitement has drawn concerns that the market might be a little bit overvalued. We think it's still room to run, very different than the tech bubble, which I think it will be a good story here headed into 2026. Again, focus on the fact that the economy is avoiding recession and the Federal Reserve's lowering interest rates. That's a good combination for both stocks and bonds. On the bond side, they do well when the Federal Reserve's lowering interest rates. We think that's a good story headed here into 2026. And of course, this winning more by losing less story, always important, always a good reminder why we build portfolios the way we do. best way to build wealth over time. So, Jason, with that, maybe I'll stop sharing. We got a couple of the charts; these don't count. But see if there's any other thoughts, comments, or questions out there. Love to hear what's on everybody's mind.
Does anyone have any questions for Mark before we wrap it up? I mean, I'd like to say that the last thing you talked about, the 90% capture, was, I would have never thought about that actually. I mean, I'm new to this stuff, and that's really good information. So,
Yeah, and it's
if anyone
really,
has any
one of
questions.
the things that makes that chart work is when you get big bear markets like that, that's when
Mhm.
that works, right? If the market was only down 10, 20%, the math wouldn't work out that way. But once you start getting into 30, 40%, 50% bear markets, it's like that chart will work. And at one point, it was actually a 50% capture ratio, beat the overall US market at one point
Wow.
coming out of the global financial crisis. We've just had some really good markets here, especially the last 3 years. So that number's climbed a bit. But I think it's important to acknowledge, right, how the math works, right? It's, if you can stay away from those big bear market losses, that's why diversification so important. That helps you build wealth over time. I think it just gets lost because we looked at the one chart. I think 20% of the time we're in a recession or within 1 year of a recession. So it just doesn't happen quite as often as the periods we're going through now. So it's easy to lose sight of the fact that, hey, we're diversifying to limit those losses. And just trying to capture a good chunk of the upside in the good markets. That's the winning formula. So, a good point. And I thought I'd embellish there a little bit. That's always one of my favorites. And you can see I have a lot of favorites there.
Yeah, that part was great. Yeah. Anyone have any questions before we wrap it up for tonight?
And certainly, if you have questions later, you can run them through Jason and the crew at AQuest, and we'll certainly happily answer those. But thanks for having me again, as always. Enjoyed it.
Yeah, thank you so much, Mark. Yeah, very insightful. And yeah, if there aren't any more questions, then I want to thank everyone for joining tonight. And like Mark said, if you have any more questions, you can contact us at AQuest Wealth Strategies